Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner with Alan Clopine. Big Al, he's a CPA. Hey, Social Security's got, what, a couple of different tweaks, huh?
Well, every year they have some changes, and I guess if you look at updates for this year, Joe, there is an increase.
Speaking of sexy, that's from Mary Beth Franklin.
Yeah, that's right, huh? It is from Mary Beth. How'd you know?
Yeah.
So our increase, Joseph, is 0.3%, which to put in dollar terms, the average retirement worker will get a $5 monthly benefit increase.
Killed it.
$5.
There you go, PBR me, ASAP.
PBR. That'll buy a case, right?
Yeah.
A month?
At least it can.
At least it can. But here's the problem. The Medicare premium for the average went up about $4 a month.
Solid.
So you're only getting $1.
Yeah.
So you might not even get a can of PBR.
Yeah, right. Maybe a 6-ounce draft at the local dive bar. Maybe.
I think you get a sip.
Like on a Sunday from 10:30 to 11.
Special, super special rates.
You got to hurry up and get there.
So,
we did that. So I worked at a bar in Gainesville, Florida. I went to the University of Florida.
Yeah.
And so we did
Sunday morning church special?
We had, NASCAR, big NASCAR people back in Gainesville.
Okay.
So, yeah, we would sell these Molson Ice.
Yeah.
Oh, yeah, I mean, it was just awful beer. Well, I'm sorry. I don't mean to offend anyone that enjoys Molson Ice.
All our listeners. What are you talking about?
What are you talking about? Molson Ice. Oh, it was cheap. It just stunk, and it was like $6 for like this little 6-ounce glass.
Okay.
Place is packed. Packed. And I'm just just pouring 6-ounce drafts all day long.
6 ounce, okay.
Yeah. And I probably poured 10,000 of them.
Yeah.
Made $8.
So hence you decided to go into financial planning.
Yeah.
Right.
Yeah.
And start your career.
6 ounces for, I think it was, for $1.
For $1. Well, there you go. Yeah. So you go back to Gainesville and
there you go. Watching NASCAR.
With that $1 that you get
10:30 to 11 special.
Now, what they're saying is this is the smallest annual increase since the automatic cost of living adjustments began in 1975, although there was actually 3 years where there was no increase. So I guess you really have to count those. 2010, 2011, 2016, there was no increase whatsoever.
Because there's no inflation.
Right, that's exact, because it's calculated based on inflation.
I'm going to get an email from that.
Yeah,
what? You don't think there's inflation? What you're... according to what the CPI index.
Yeah, that the Social Security Administration uses, and you can argue it's not a true reflection,
yes,
but
and I would agree with that.
Yeah, we could. Yeah, me too, actually. But anyway, that's how they do it. So how about this? For high income workers, Joseph, the FICA tax wage base went from $118,500 to $127,200. Went up about $8,700. So that means that, let's say you make $150,000. Last year, your Social Security was only withheld on the first $118,500, and then there is no Social Security after that. Now it's $127,200. So in other words, more of your money, more of your wages are going to go to the Social Security Administration as a high wage earner.
Well, yeah, that increase was, what's the percentage?
That's
a pretty large percentage.
That's about a 7% increase, give or take, 6 maybe. Anyway, now I will say the Medicare part of Social Security. So Social Security, by the way, that's 6.2% of your wages. So if you make $100,000, $6,200 is withheld for Social Security. The Medicare part is 1.45%. So make $100,000, that's $1,450. Now, there is no cap on Medicare. So you're an athlete and you got this big contract, $10 million, you got to pay the 1.45% on that whole $10 million. Although the 6.2 Social Security part, that only goes now to the 127.2.
Well, with the Affordable Care Act, too, isn't there another increased premium on that?
That's
over a certain dollar
absolutely
threshold?
right. And so for a single taxpayer over 200,000, you got to pay an extra 0.9%. And
Call it
for
1.
Yeah, call it 1. Okay, good. I like how you round.
Yeah.
And then a married couple, it's over 250,000. So yeah, you got those amounts as well. 2017. Social Security beneficiaries that are under full retirement age, there's a certain limit as to how much earned income they could have.
So 62 to 66, let's say. If you
Correct.
take it early, you take that permanent haircut, but also if you have earned income, they're also going to reduce that threshold.
That's right. And for 2017, it's 16,920.
So 17 grand
Yeah.
versus 15.
That's
So-
right. It went up about $1,200 last year. So in other words, you can now earned income. Let's explain that. That's if you have salary. That's a job. That's if you have a business that you're involved with, the self-employment. That's earned income. Now you can be 62 and make $1 million, but it's from investments or whatever. Then that's not necessarily earned income. You still get your full Social Security. But if you are working, you're 63 years old, and you've got a job where you're making 50 grand a year, well, you don't need to take your Social Security because you don't get any anyway.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al, thanks for tuning in. Hey, got a great guest, Big Al. We got Douglas McCormick on the line. Family Inc.
Family Inc.
Great book.
It is a great book. It's all about families and what they ought to be doing with their finances.
I mean, it's just looking at it maybe with a different lens when it comes to a family CFO. I mean,
Yes.
You've been a CFO of many
I
companies.
have,
You're a CPA.
and
You're a
of
pretty
course
smart guy.
that's why I can relate to the book, because I have been a CFO, and I think the CFO function is critical.
Douglas, welcome to the show, my friend.
Hey, thanks very much. Glad to be here.
Hey, well, tell us a little bit about yourself and what made you write the book Family Inc.
Well, I think in many cases, my life experience is a product of why I think a framework like Family Inc. needs to exist. So, I'm a undergrad from West Point. I was an active duty Army officer for 5 years. And after that time, decided that, a military career was not for me. And so I went back to business school at Harvard. And I graduated with a master's degree in finance, and then worked on Wall Street for a couple years. And, really, in spite of all that great experience, never had what I consider to be a good kind of foundation in personal finance. And so I think today it's one of the biggest problems in America is financial literacy, and our traditional education system is not doing a good job of teaching these principles. And so for me, the Family Inc. Kind of framework, if you will, is an elegant way to help people think about all the competing choices that they have out there with their assets and their finances.
There's probably, at last count, I don't know, personal finance books, there's so many of them out there. It's like if I want to get an exercise book or fitness book, I mean, that's $1 trillion industry, and still we have an obesity problem. And there's billions of books out there when it comes to personal finance, and we still have a financial literacy problem. Why is your book different?
Well, I think my objective is not to give you answers, but to teach people how to think so they can get their own answers. And I think that what is unique about Family Inc. is the fact that it provides people a framework, and essentially, just to for the listeners' benefit, the premise of the book is that all families could look at themselves like a business, and each family has predominantly two big assets. They have their labor assets, and they have their financial assets. And the name of the game is to manage those assets, to do all the things you want to do in life, and when it's come time to retire, to have capital to support your consumption. And I think the great thing about that framework is businesses have been dealing with these kind of decisions for many years. There's all kinds of good established best practices, and when you look at the family that way, it really allows you to borrow many of those tools and best practices that have been kind of time tested in business.
Doug, give us a sample of some of the things that families ought to be looking for or looking to do.
Well, let me give you some of the big mistakes in my mind. First of all, I think you can't really talk about financial independence or financial security if you're not thinking about how to maximize your labor potential. And, when's the last time financial advisors proactively talked to clients about, are they managing their career? Are they making good investments in things like education or entrepreneurship? I think another thing the book does a good job of is helping people focus on the right time frame. So, for example, when you think about how your career is going, or you think about your investment returns, everybody wants to talk about this year or next year or last year. And the reality is that game is a many, many year game. And so to think about your performance not in terms of how you got paid this year, but in terms of lifetime compensation, I think that's a very important change in time horizon.
Yeah, I think it's also about decisions that you're making as you go along. Sometimes little decisions can make a big difference.
Absolutely. And, I think one of the things I really preach in the book is a family CFO's job is much broader than simply how you manage your investments or how you budget. It's things like managing your risk. It's things like training the next generation in the family to be good stewards of your capital. And it's things like investments in education and entrepreneurship.
How you calculate net worth, you're taking a look at, the value of their labor. That's a pretty interesting way to look at, someone's overall net worth. By doing that, what changes do you think people would make?
Well, I think, first of all, it highlights a really interesting circumstance for many Americans, which is your largest asset is likely your labor. And for you to really accumulate wealth, you're likely to do it because you're making good decisions about your labor. And I think, the other thing that's interesting about that paradigm is it demonstrates that for young people who have the least financial capital, in many cases they have the most wealth because they've got more time kind of available to make decisions about their careers.
When you look at it, Alan and I see many, many people, and it's like we ask them, it's like, well, what do you think your biggest asset is? We live in Southern California, and 9 times out of 10, what do you think people tell us? It's their home, right?
Sure.
But it's their ability to earn an income. It's the $200,000 income that they have, and they don't necessarily look at it as an asset in what that potential asset can do for them in regards to wealth. So I think if people looked at that a little bit differently, maybe the financial crises that we're going to see, people approaching retirement with barely a nickel to their name, we might be in a little bit better spot.
Yeah, I think the other thing it does is it helps you, I think, more rigorously think about what the right asset allocation is and what the right risk profile is. So in the way I look at net worth, it's not only your labor value, but I include things like your house, obviously, but also your expected Social Security. And we can debate the value of your labor. We can debate the benefits of Social Security. But I think in aggregate, we can all agree those are real assets for the family. And so, one of the byproducts of the framework for me is I generally recommend folks embrace more equity exposure than traditional advisors would suggest. And I think that's because when you look at all those assets, labor and Social Security behave much more like fixed income or an annuity than they do in equity. And they really are assets that I think the family gets to use over the course of that retirement period.
I would agree with you 100%. How would you calculate that? So for our listeners is saying, all right, well, here, maybe I shouldn't be, now that I'm retired, collecting my fixed income. Maybe I have a small pension, Social Security, but I'm also maybe heavily weighted in fixed income, bonds, cash, CDs. How would they look at that maybe a little bit differently from a numbers perspective? Is say, all right, well, here, I have a certain dollar figure when it comes to my Social Security. How would you do that calculation to see what would be the appropriate asset mix in regards to equities?
Yeah, so, both Social Security and labor you can roughly calculate similarly, which is you kind of make assumptions about either how long your working career is or how long you're likely to live based on some kind of published life expectancy table, and then you project what is either your future income and some kind of growth rate and some kind of tax rate, or in Social Security you project what your future benefit is, and you essentially discount that back with some adjustment for inflation. And so what I would tell you is, first of all, on FamilyInc.com, there's calculators for both your labor and your Social Security, so I've tried to make that relatively easy. The second is, I promise you, the estimate you come up with will be wrong, and it's less about projecting a specific number and more about thinking about that asset in the context of your overall plan, because it's going to be directionally right.
Right. And one last thing, West Point. little Army-Navy game? Did you get a...
Oh, man, I tell you what. It was a long time coming, and I'm very happy for the win. Having said that, I'm going to do my best to be humble because we are 1-15, and so I'm going to take my win and hope that we're on a good trend line.
That was a phenomenal game, man. That was, I was definitely rooting for. We're in San Diego, so we're a big Navy town.
Yeah, sure.
Yeah, but big military town, I would say.
It was a great game, and I'll tell you, I think the thing that's even better than the game is the school spirit and the way these young men and women, really embrace what is best about our country.
Hey, one last thing, I guess, is that we have a lot of military that that live here in San Diego. And when you look at that, of course, you went, you served our country, which thank you very much for doing that. But I think military individuals have a little bit tougher time when it comes to, when it comes to financial planning and financial literacy in a sense, because they might be traveling and then maybe they're married and maybe the spouse can't work because they're constantly moving. I mean, what advice would you give our servicemen and women here?
Yeah, well, first of all, thanks for asking. One of my primary objectives for doing the book is to support the military community and the veteran community with a good framework to help think about navigating transition. And I think, first of all, the big thing I'd say for the military community is you have to acknowledge that your circumstances are different from mainstream America, and so your plan must be different. And you mentioned some of those differences. 83% of veterans will transition pre-retirement with no retirement benefit. Most veterans start a family slightly earlier. They have a less professionally developed network because of frequent moves given the military. And in many cases, the spouses are unemployed or underemployed. And so understanding all those things, as well as the unique assets that veterans have, like this tremendous experience and the GI Bill, they can have what I believe to be really good economic prospects, but it really starts with understanding those differences. I think the family work framework can also be applied to their circumstances.
Yeah, here's what I want to do. Anyone that is served our country and call our number, I will buy you personally a book of Family Inc. Here's the number, 888-994-6257. Call that number. And then Alan will buy that book for anyone that has served our country. It's a great read. It's so logical. Doug, thank you so much for your service. Thank you so much for writing this book, and thank you so much for your time today.
Hey, thank you for the kind words and the very generous offer for our veteran community. Appreciate it.
All right, show's called Your Money or Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money or Wealth. Joe Anderson here, certified financial planner. Big Al Clopine, CPA. Favorite part of the program is that we're about to take some email questions from a little site called Investopedia. If you ever check it out, I mean, it's a pretty good site. They send me questions. They say, hey, some people submitted a bunch of questions. Can you answer them? I say, sure. We say it on the air, and then we have a little talk. Because some of these questions are kind of funny.
They are funny, and some are. I'd say in most cases we don't quite have enough information, but we do our best with what we have.
Yeah, so we can stretch these things out.
Or you can just switch the station right now.
Sure, but I think most people love this stuff, Al, because they might have a similar question.
Well, you're right about that, and maybe they're afraid to ask.
All right, let's get to this.
Okay, what do you got?
All right. I am currently contributing to a company-sponsored 401k plan.
Okay.
I contribute 8% annual salary of $60K.
Okay.
Which comes out to $4,800 per year.
Okay.
Can I also set up and contribute to a Roth IRA? If so, what can I contribute?
Okay, the Roth IRA, the answer is absolutely yes. So Roth IRA, you can contribute $5,500 per year. Now, if you're 50 and older, you get a $1,000 catch-up, so you can do $6,500. You know what, though, Joe? Your 401k, his or her 401k may have a Roth option on it, right? And then, in that case, you can contribute, if you're under 50, $18,000 total. You already got $4,800 in. Let's call it $5,000, just easy math. So you can do about another $13,000 in the Roth side of your 401k if it has that option.
Like $60,000 now.
I know. But maybe
So,
maybe
just jam
maybe,
everything that you make
maybe he listened
into your retirement account.
Maybe he listened to the extreme savings segment
exactly.
a couple segments ago.
Anyone that asks a question,
he's going, yeah, Big Al, I want to do extreme savings. Where should I put it?
Let's do this. He's at 8%, and then he wants to go Roth IRA. I think that's good. But here, I guess the point of this is if you fully fund a 401k, you can fully fund a Roth IRA if you're under the income limits.
Correct.
Right? So there's qualifications for the Roth IRA. 2017, Al, do you know the numbers?
No, but it's about 118,000, I think, is where it starts phasing
probably 118,
out.
134 for single.
I think that's the phase out for single. For married, it's probably 185 to 195.
They probably increase it $1.
We know last year, so we're adding 1,000 to it.
Yeah, yeah. All right. So, that's a good point. Is both plans can be funded. Also, spousal plans. So let's say this is that you have one spouse working, one that is not working, right? You contribute to your 401k. You can also contribute to a Roth IRA. Your spouse that's not working could also contribute to a Roth IRA,
right,
even though that spouse doesn't have earned income.
Yeah, you can use the spousal income. So in this example, let's say he or she is under 50. So that's $18,000 into the 401k, $5,500 into his or her Roth IRA, and then the spouse could do $5,500. So man, now we're up to about $29,000 if you want to into retirement accounts.
Are stock dividends and stock splits taxed?
Okay, that's the question?
That is the question.
Stock dividends are taxed, and they may be referring to I got a dividend in a stock, but I'm reinvesting it. Maybe that's what they're thinking. And so when that happens, it's as if you received the cash and then put it back and bought shares. That's how this works with stock dividends. So yes, those are taxable. And what was the second part?
Stock splits.
Stock splits. No, there's no taxation on stock splits.
Because nothing really happens.
Yeah, your stock price changes. So let's say you got 10,000 shares, and it's $1 a share, $10,000. It splits. Now you got 20,000 shares, but now it's 50 cents a share, right? So that's how it just changes the amount of shares that you have, what they're worth, and your cost basis per share. Everything just changes pro rata.
Right. The dollar figure doesn't change, so there would not be a taxable event.
Correct.
Because as Al said, let's say if it's $1 share, 10,000 shares, that's $10,000. Well, it splits. Now it's 50 cents a share, and you got 20,000 shares. You still have $10,000 of value.
Yeah, exactly. There's no taxable consequence there.
But yeah, the good point with stock dividends is that they don't necessarily. Most people don't realize it until they get that 1099 right from the custodian or the company. It's just like, well, I didn't receive any income.
Yeah, why do I have to pay tax?
Why do I have to pay tax?
And so those stock dividends, and so here's what's interesting. People don't realize this when you're reinvesting. It's like you're taking that income and buying back into that same investment, and so then when you sell it, your cost basis is going up because you're investing in it each and every quarter. Let's say as you receive those dividends. So I'm just going to say, so you bought an investment for $10,000, and 5 years later you sell it. Well, maybe your tax basis is $11,000 or $12,000 because of all these stock dividends.
So. Yes, it's tax, but it also increases your tax basis.
Yeah, which is kind of a weird term, but that's true. So it means when you do sell that investment, you'll have less gain.
Right, because you
already paid some tax on it.
You kind of pay tax along the way.
As you go.
Couple of things, too, with dividends. It depends on what the portfolio looks like, because you're only taxed on dividends if it's outside of a retirement account.
True.
If it's inside your IRA 401k and there's dividends that are distributed, and then you reinvest those dividends, it's a tax-deferred account. You're not going to pay taxes on that until you distribute money from the account. Then you're taxed at ordinary income.
Right.
If you have qualified dividends, now you have a special capital gains rate.
Yeah,
versus non-qualified dividends.
That is true, and that's a fairly new concept, Joe. Maybe, I don't know, a decade ago, qualified dividends came. It was during President Bush, George W. Bush, this new concept, maybe it was 15 years ago, I don't know, where a dividend that you receive from a U.S. company gets preferential treatment, gets preferential capital gain treatment, which is a lower tax rate. The tax rate for capital gains for most people is 15%. Some people pay 20% if they're in a high bracket. Some people actually pay nothing if they're in a low enough tax bracket. But that's a lot better than the regular tax rates that currently go up to 39.6%. So to get that preferential treatment is great. Now, that's if it's outside of a retirement account. If it's inside of your retirement account, there's no preferential treatment. When you take money out of your IRA or 401k, it's taxed as ordinary income in all cases, unless, I shouldn't say all, unless you have basis. In other words, maybe you open up an IRA where you are not allowed to take a tax deduction, so that when you pull money out of that IRA, not all of it's taxable because you didn't get some benefit when you put the money in.
There's another case, too.
Okay.
If I have company stock inside my 401k plan.
Oh, that's true. NUA, you ought to go there?
I guess so. What the hell? So, yeah.
In 2 minutes or less.
But, so let's say if you have company stock inside your 401k plan, another strategy that you could do is you could take that stock, right, out of the 401k plan, put it into a brokerage account. You pay tax on the basis, so whatever you paid for. Let's say you paid $1 a share, and now it's trading at $10 a share. Well, if you move the share out, you pay a tax on $1, but there's still $9 of appreciation because now the stock is worth $10 a share.
Right.
So you pay tax on the buck, but then that $9 of appreciation now is taxed at capital gains rate versus ordinary income coming out of the retirement account. So net unrealized appreciation is another phenomenal strategy to get that tax diversification that people need in regards to creating that income in retirement.
Yeah, Joe, and that has to be a 401k only. It can't be company stock in your IRA. And if you roll over your 401k to an IRA, that strategy is lost. So if you are near retirement and have company stock, net unrealized appreciation is something that you absolutely want to think about. Because, Joe, taxes don't stop when your paycheck does. In fact, when you start tapping your retirement nest egg, it comes with all sorts of new rules, but also opportunities. So think about this. Instead of contributing to your tax-deferred plans that reduce your taxes, you start tapping those savings for income and paying taxes at your regular rate. So as you near retirement, tax planning actually becomes more important than ever. But you must use a forward-thinking tax strategy. If you're just thinking about taxes at 1 year at a time in a silo, you could make some big mistakes because...
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, wrapping things up here on Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He is a CPA. Hey, thanks for tuning in. I have an interesting one here.
Okay.
Can I use life insurance like a Roth IRA?
Okay.
All right. I make too much money to contribute to a Roth IRA. However, I would like to save more in a tax saver manner.
Okay.
The spelling's not that great.
Tax efficient manner, I think, is what they meant. But we'll go with tax saving manner.
Sabor.
Yeah, Sabor.
Yeah.
Okay.
I've heard I can use life insurance like a Roth. How do I do this, and is it a good idea?
Oh, that's a great question. Well, I'll start with the answer is yes, you can. And then, Joe, you can say why it may or may not be a good idea. So certain life insurance policies allow you to put more money into them than the actual life insurance premium. So you start building up a cash surrender value. And you can, in many cases, invest that how you see fit. It grows inside that life insurance policy. There is no current taxation. And then you get to a point where you retire. If it's a big enough balance, you can actually borrow against that, and that's tax-free. So it's kind of, in essence, like a Roth IRA. And you do hear a lot of life insurance agents talking about this. But there's some issues there.
Yeah, I mean, there's pros and cons to any type of strategy that you take a look at. So if you look at it on the surface, it's like Alan, I don't know if you listened to a couple episodes ago, but the big wallet on Big Al.
Well, that's what you inferred because I did a 15-year mortgage, and I said, and I'm fully funding my 401k.
Fully funding his 401k, backdoor Roth IRAs, and just jamming all this money everywhere. It's like, wow, look at the big wallet on Big Al. So, all right, so Big Al, right? He makes a lot of money. and he's already fully funding his 401k plan.
Yeah.
He's jamming a bunch of money towards mortgage. He's going to be debt-free before you know it. It's like, all right, well, where else can I save some money? I really like tax-free. So, all right, well, here, how about you do this? You can take X amount of dollars after tax, just like a Roth. It can go into an account. It will grow tax-deferred, and when you pull it out, it will be tax-free. But with this particular strategy, there's no 59.5%, 10% penalty if you pull it out prior to 59.5. There's no limits to your income. You can make as much as you want. You could fund it with, there's no $5,500 limit. You could put $10,000, $20,000, $30,000, $50,000, $100,000 a year into this particular product. All of that grows tax-free, and then when you pull it out, you get a tax-free income for life.
Okay, so sounds great.
Right?
Yeah.
But there's a cost to this. It's called the cost of insurance. And it's not as glamorous as it might sound, as I just explained it, because you have to really dive into the details here, all right? Because first of all, it's an after-tax contribution, so if you're in a high tax bracket, you have to put that into effect. If you have other retirement accounts, why don't you do that and do a Roth conversion, right? Because you're paying tax to get into a tax-free vehicle with no cost of insurance. Then you get into the cost and fees and the structure of the those policies. They're very, very expensive, like just the mutual fund charges and the type of investments. Unless you get into like an indexed UL or whatever. Just a full disclosure, Alan and I do not sell life insurance. We're not licensed insurance people. We're just very knowledgeable about all sorts of different financial planning strategies. There you go.
Yes, that's compliance. Good job.
So, yes. So I think it's sold like that. It was like, okay, well, here, it's like a super Roth IRA. I've heard terms like that,
right?
Or they call it, I forget under what section of the IRS code that life insurance death benefit is tax free. So they say, well, what about an HR 147 plan or whatever the code is?
Is it 419 or 412?
The 412Is and the 419s, all those blew up too, right?
Blow up. Yeah, you're right. Yeah,
and this is very common in I think in the financial planning life insurance world of using these particular products.
Sure.
You could use a variable universal life and index universal life. I'm not saying that sometimes it may work. I would say 90% of the policies that Al and I have seen with a strategy like that, they didn't fund them correctly. They were exaggerated in regards to how much that policy would actually earn in form of rate of return.
Right, because when you get the policy, you get what's called an illustration that assumes that you are going to earn 8% or whatever the number is that the agent put in there for you, and you're thinking, oh, I'm going to earn 8%, and you're right, Joe. These life insurance products generally have some fairly high costs, and part of it's the cost of life insurance itself.
Because as I age,
right.
So when the cost of insurance increases because I'm closer to my life expectancy.
Right, and so you don't realize that. So now you're 70, ready to start pulling money out, but the cost of life insurance to keep this policy in force goes up each and every year. And so that's honestly what we've seen is more often than not, you don't quite get the benefit that you thought you were going to get.
Right, because it might have been illustrated to say, hey, this thing is going to earn 10% gross, but then net of all fees, it's only like 5%.
Right.
Right, and then they don't fully fund it, right? Because the illustration shows, hey, you have to fund this thing by $40,000 for the next 20 years.
Right.
And then guess what? After 2 years, they stop doing it, and then they keep that $80,000 into the overall policy. They got $1 million, couple $1 million death benefit. So I would say there's more cons than pros. I would highly suggest you talk to a independent fiduciary that doesn't sell life insurance, because if you go to another life insurance agent to say, hey, does this make sense? They're going to say, yeah, but this policy stinks. Buy this one.
Yeah, I got a better one.
Yeah,
I think, is it fair to say that most fiduciary and fee only financial planners would probably not recommend this strategy?
I would say that is equivocally 100% they would never recommend that strategy.
Yes, I would agree with you. And we are fee only. Because, in other words, there's no commission to be earned. If someone has a commission...
Because I tell you what, Al, is that to look at what that individual's trying to do, there's better ways to create that income. Plus, let's say if I have a non-qualified account, all right? So the taxation on exchange-traded funds or institutional-type shares or even individual securities, the taxation on that is very, very low. If you have actively managed loaded funds, right, which I'm sure a life insurance agent might also recommend to you, they have a high turnover, and then the taxation on those outside of retirement accounts cause unnecessary tax, and it puts a weight down on the overall portfolio. So they'll say, no, you can shelter it. It'll grow tax deferred for you, so all of that growth will continue to go in the policy. But nowadays, I mean, you could be extremely tax efficient in your brokerage account by tax loss harvesting, tax gain harvesting, using different investment vehicles that don't create that tax. And then you look at, all right, well, here, do I have a large IRA or 401k or 403b or TSP balance? I can convert that into a Roth IRA and have that grow 100% tax-free. It will give you the same impact without the huge cost of insurance and all the internal costs and fees.
Right, because you're paying for that insurance even if you don't really want it.
Right. You're trying to create tax-free income. Well, yes, the life insurance contract will do that, but if there's no need for the insurance, absolutely don't do this. But if you do need the insurance, it may work. May can I stretch that thing up? May work.
May work. That's right.
So, never say never.
Yeah, that's true, and I'm sure it has worked from time to time. Our experience is it doesn't generally work as promised.
Yes, I would agree with that statement. Wow, we spent 10 minutes on life insurance.
Yeah, we did.
All right.
Didn't expect to.
Go see your insurance agent, I guess. All right. Hey, hopefully you enjoyed the program. Alan and I certainly enjoy doing it every week. Well, every other week, usually. We're have a little energy today. Next week, we'll probably be
awful.
Awful. Or upset with each other.
Yeah, something.
Something like that. All right, we got to go. Time's up. Hey, have a wonderful weekend. We'll see you next week. We got more great guests lined up. For Big Al Clopine, I'm Joe Anderson. Check out purefinancial.com for more information about us. And we'll see you next week.